Good morning. I'd like to introduce you to best practices for financial analysis using business intelligence. My name is Chemich Pungu, and I'm here to present effective techniques for high quality financial analysis using business intelligence software. So this session is pretty short. We're going to focus firstly on a short introduction, which we've just done. Then we're going to do a problem definition, proposed solution, and contact information. Right. So to get started, we want to have an introduction to what financial information is. Well, financial information, we have got the income statement and balance sheet, which you've seen as information that is always presented to either executive management or to a board. Now there is a problem with this information. Yes, it has got its benefits, but we're going to focus on the problems. It has got limitations in what it does. The traditional approach to presenting financial statements to management teams is primarily to involve simple line-by-line classification of charts of accounts, items, activities during the period. This method follows a rigid top to bottom format that overlooks the historical context of the business, makes it difficult to conduct deep analysis into what, why, who, how, and where are behind these figures. Then it provides limited opportunity for management to engage with strategic brainstorming based on the data presented. And lastly, as a result, the traditional presentation style hinders insightful generation, strategic decision making, and meaningful collaboration at the leadership level. So with this problem, what do we do? Let's let's overview the Excel and business intelligence. Excel formulas and features have got their functionalities, but they have limited comprehensive data analysis and manipulation. Business intelligence dashboards, on the other hand, provide dynamic dashboards and visualizations that support interactive data exploration and reporting. Enhancing understanding of the business, dashboards highlight key concepts, aiding effective learning and better decision making for the business. So now that we understand the two concepts of Excel reporting and intelligence reporting, we want to see how we can transition from Excel reporting to business intelligence reporting. The first thing is to understand three W's: why, who, and what. Why? So we understand the reasons for this information and making sense out of the sea of data stored on the information systems. Who? So understand who the target audience is, what type of information they require, and adjusting the reports to their level of understanding. And the what? Understanding the organization's short, mid, and long-term goals, and how this information is going to play a key role in the organization achieving these goals. So once you clearly set up these goals, you should be able to now move into creating a financial dashboard. So what are the highlights or key features to demonstrate in this dashboard? One, you have to identify the areas of interest. Focus on the necessary areas of the business intelligence to help focus the audience attention on specific important details for better understanding. Next is to highlight these important areas of focus. And then lastly is to have a discussion with these information. It's a different type of information, so it's different type of audience engagement. Rather than having someone who just sits and tells you information, this is more engaging. So it ensures that information can dynamically guide viewers to key areas, enhancing engagement and comprehension right there in that boardroom. So we're going to have an example of a transition from the traditional finance statements to the business intelligence statements. So we're going to first look at what the traditional income statement and balance sheet looks like, and then we're going to look at the business intelligence using Power BI. So here we move on to what real financial statements look like. So here we have two things. We have the income statement, or the balance sheet, sorry. That's a typo. Sheet. So the balance sheet, we have the non-current assets, current assets, the current liabilities, and obviously long-term liabilities. And you can see this business is valued at about 25 million kwachas. On the other side, we've also got the income statement. This business has got 5 revenue streams. In those 5 revenue streams, we have what the total revenue is of all of them. Then we have what the total direct costs are, giving it a gross profit of that amount. And we have all the line items going all the way down up until you come to what is considered the operating costs, profit before exchange differences and depreciation. And then once applied, the unrealized and realized gains and losses and depreciation, we come to a net operating profit of that amount. And so this is what we see as a normal type of accounting. So now the question is very simple. There's so little scope for management to brainstorm ideas effectively from that type of report. Times have changed for the finance professionals since the beginning of this century, and we've seen a big push for finance professionals to be more involved in decision making the boardroom meetings with more executives. There's a need for more ideas that flow from bottom up instead of instruction coming top bottom. And finance have also got understanding of what is happening are key to the ideas flowing from bottom up instead of top to bottom. And the use of business intelligence software means more meaningful insight into the business. So this is what I'm going to showcase today using a model developed here in Zambia from my desk at home. Have you ever heard of interactive dashboards? Well, I'm going to give you an example of an interactive dashboard. With the help of Power BI, I can change information from the standard income statement, which is that, into business intelligence model, which is that. And here's an example of what it looks like. So here we have a revenue analysis, a cost analysis, a working capital analysis, financial ratios, cash flows and loans, and asset quality analysis. So on these 6 tabs, we're able to understand what the business has been going through for a period of time so that we can be better placed to understand. The first tab is on the first tab here of revenue analysis. You notice we have the total revenue for the period of January 2023 up until October 24, which is a billion. And from this, what we have is we have a breakdown of what this revenue is cumulatively and what we have on a month-on-month. And here we have a year-on-year change. Now you can see from this flat line it's 0. That's because of lack of information from the previous year. But then you find the next year there's been an increase. There's been an increase of revenue year on year. And then here we also have another decrease year on year. So you can understand that the business did have an up and down during that period. And now what factors led to this type of breakdown? For example, here we can analyze here and explain. You can see that 17 million, 1,770,000 accounted for the majority of hardware revenue, offsetting the decrease in 144. So you can see that the decrease was offset by the increase in hardware. So that's information that you never knew. What about here? Well, we can click again, right click, analyze, explain this increase. 44,000 accounts for the majority of increase from hardware, offsetting the decrease of 1.7. So already there you've been shown how that increase was offset by that decrease. So already you have information as to why those numbers are what they are today. And of course, the management can then understand and uh, can then present why, be specific as to which numbers and which areas are more concerning. Of course, all this can be built into a model, which would take a little bit longer. But if you engage management, they should be able to help you. On the cumulative revenue, you can see that the numbers really go up until December. Then in January they flow down, and up until December go up. Here, month on month, you can see what the increases are. It's been decreasing month on month, and then here finally increase at the end of the year. And then of course you can always ask the question, why the decrease? So here you right click one of the numbers, analyze, explain this increase. That amount accounted for majority of the increase in hardware revenue, offsetting the decrease of 917. So already you can see that there has been an increase in hardware, and then a decrease in farming equipment, a decrease in project revenue. So it is project revenue. Sorry. So let's say for example here, let's look at the same. This is project revenue, and that's another one. So here we have hardware revenue, and analyze, explain this increase. 9.6 accounted for the majority increase in hardware revenue, offsetting the decrease of 917. So this you can see March to April, there has been an increase in hardware. So that is what was offset. So you can either go one by one, analyzing each of the divisions: appliances, farming equipment, hardware, installation, and project revenue. Let's move on to the cost analysis. So now that we understand what our revenue is and what has been causing the revenue, we look at now the direct costs. What are the costs? What are the direct costs of appliances, farming equipment, of hardware, and of projects? Let's take, for example, here you see, this is coming to November. Well, this is December, actually. And you look at projects, for example, and you analyze, explain this increase. There has been a majority increase among hardware revenue offsetting. So we can already see what the cost of sales, the direct costs are in relation to the revenue. Operational costs, we have accounting and legal, administrative, client entertainment, fuels and lubricants, mobile communications, printing, and repairs and maintenance. And you'll notice that from January, there's been a downward slope up until the end in December. And then January here, it's basically being kept low. So let's explain this decrease. 8.3 accounted for the majority of decrease among hardware revenue, setting an increase of 728. So we can see how in repair and maintenance in the hardware division, there has been a decrease, and that's been going down. And here also have human capital costs. We have the salaries and wages of administration and all the different departments, and also the NAPSA, and also the staff canteen and entertainment. So you come to understand that this is what has been spent this whole time. So there are some ways in which this has been happening, but you can see that it has been effectively decreasing. So if you want to analyze this, there's another report that comes up there. So you have an understanding of what the business direct costs are, what the operational costs are, and what the human capital costs are, and how this happens. Right. Then next you have the trade receivables, and here you come to understand why we have the business is in this state. Why do we have such high receivables? There's an explanation as to why, because receivables basically should be in line with what the company policy is. And you can have a discussion with your sales team, for example, regarding receivables. And the trade creditors, we see that trade creditors hasn't been paid that much, and you can understand why, especially that this is a cumulative number. That has had an effect of to why they're not being able to pay creditors, and why the creditors has been increasing this whole time. So we have, for example, this in this instance is advance income tax, which has been paid, and that's what has caused this. So you can see that there's been a decrease. And then next, we also have analysis of what the bank accounts have been looking like. How has money been flowing through the organization? You can understand how the money has been flowing through the organization. Then finally, we also have now the financial ratios. And the financial ratios, you're able to tell what your asset turnover was over a period of time, and your current ratio, and also return on asset. You can, for instance, want to move just to have January, and you can look at how your numbers have been moving, for example, for that year. If you want to move to another period, you can move there, and that gives you the entire spectrum. So let's say you want to start from January all up until the end. Let's look at, for example, ratio analysis for this period. Quarter one, we had an asset turnover of 0.5, current ratio 2.6, return on assets 0.7. So you can, and if you look on the right hand side, you have what your total return on asset is, your total GP, your total creditors, your total net profit, what you're holding in monthly inventory, and what your monthly purchases were. Let's take for another example this period where you have a different type of scenario of a current ratio. What happened then? So on this one, because your current ratios, asset turn of 1.2, current ratio of 2.18, and return on asset of 0.09, you find that you had a 40 million kwacha DP, 40 million GP, 130 million in creditors, 5 million kwacha, 5 million in net profit. That monthly you had purchased for a total of 53, and then inventory holding was 10. And this is what, and then that was your revenue. So you can understand what your business looks like at any given time. And so as you decide to understand your business more, to have more intelligence about your business, you're much better suited to make a decision as to what to do. Like for example here, even though there was asset turnover of 1.7, the current ratio of 4.4, there's return on asset of negative 1.38, because there was a 55 million GP loss. We had 57 million in creditors. There's net loss of 62 million, monthly purchases of 21 million, and monthly inventory holding of 25 million. And you can understand that maybe that was the reason why later down the line you went and made money, because you had sold everything instead of holding. So you can understand how the business works in such an instance. Next, you move on to cash flows. Again, you look at what your bank was. You can look at the movements in your bank accounts. How did your bank accounts perform during the period? Were there any deficits, as you can see, and were there any surpluses? And then you can see how your company loans were looking. And did you increase the number of loans? Yes, you did. At a certain time, you increased the number of loans right at the end. Then at the end of the day, you now look at your asset quality. Let's look at the year-on-year change in liabilities, year-on-year change in assets, return on assets, and then the balance sheet analysis. So you can see what your changes in current liabilities and long-term liabilities was an increase or decrease in your liabilities your your long-term liabilities or current assets. You can see this over a period of time. Yes, there was an increase in current liabilities in here. Why? I'm here to tell you why that is if you analyze it properly. More information. Next, you have, was there an increase in assets? Yes, there was a very big increase in assets, and there were some years there was a decrease in assets. These were current assets, and these were fixed assets. So were there decreases? Yes, there were some decreases, but there were also small increases in fixed assets. Why? Is a question that you're going to have an answer. Your management team should be able to have an answer to. Your return on assets should be able to give you an indication of how the asset is performing. And once you understand how your asset is performing, this should be able to give you reasons as to whether you're going to invest more, or you're going to cut down on costs, or you're going to invest in more product lines or different business units altogether. And then finally, you have a balance sheet analysis where you have your total long-term liability, total equity, total current liability, and total asset to let you know whether the business is actually growing or not. And that gives you more information as to what your business is really looking like at a particular time. So that is an example of what business intelligence can do for you. And I've used Power BI to analyze this business so that you're able to understand. Okay, let's move on to the next slide. Oops. So what do we do then? So we have to share this information with stakeholders and learners. We have to distribute it in a timely manner, and we use such platforms as Teams, SharePoint, and learning management systems to share reports efficiently and securely. We also ensure that the file format is compatible with what programs are using on their systems, and also have additional considerations, which means incorporating ideas, uh, having local reasons for variances, as I mean that's what you have in your team meetings, and other notes to make interactive brainstorming sessions more usable by all stakeholders. So in conclusion, effective communication, there's three positives to using Power BI or business intelligence. One, it enhances communication because information is an investment and not a cost because it enhances communication between stakeholders. It also has teamwork and collaboration. So well-prepared business intelligence serves as effective information tools and facilitates better team collaboration. Lastly, it gives thoughtful decision making. So careful study and thought into information presented and scenario-based testing ensure thoughtful and well-informed decision making by all on the management team. So I'd like to thank you for your time this morning, and I hope you've enjoyed this session of the using of business intelligence in your business, and I hope that we can be of help when you're trying to invest in your own information technology environment so that you're better equipped to make better business decisions going into the short, mid, and long term. So, from me and my team, it's thank you very much and wish you all the best. And looking forward to being of service to you.